Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from the U.S., Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Remy Blaire. Joining me here at the New York Stock Exchange this morning is Tai Wong, independent proprietary trader. Good morning, Tai. Great to have you here.
Remy. Good to be here. Fed day.
Fed day, yeah, absolutely. And this morning, for our market insight, we are joined by J.D. Durkin, CBS contributor and host of Public.com. Good morning, J.D. Thanks for joining us.
Good morning, Remy and Tai. Great to be with both of you. And you said it, the Fed day of all Fed days is finally here. I'm very excited to be with you today.
Well, you are joining us from sunny California today, wrapping up your time at the Future Proof Wealth Management Conference in Huntington Beach. So tell us about your attendance at this conference this year.
Yeah, well, this is the second year that I've been here. It is one of the world's largest, as you said, Remy, wealth management conferences, but it's truly unlike any other wealth management conference. It's not exactly in the stuffy old convention hall. It is on the beach in beautiful Huntington Beach, Orange County, California. There's live music, there's panels to attend. And as much fun as it sounds, and it very much is, let me be clear, third eye blind, quite literally, played a concert here on the beach last night for Future Proof. As much fun as it is, I'm also struck by how boring so much of it is, and I mean that respectfully, because boring, I would argue, are the fundamentals of wealth creation, the fundamentals of long-term investing. This is not splashy stuff, but that's largely what the programming at Future Proof is geared towards, because those really underscore the importance of long-term wealth, and that's tantamount to the programming here.
And JD, Tai, and I want to hear about the latest trends to advise clients, including personal finance, as well as navigating political uncertainty, especially as you join us on this Fed Day. So, Tai, let's kick off today's session. Sure. And JD, we look forward to hearing about the latest that's taking place from Huntington Beach, California. But first and foremost, we do want to do a quick market check, especially since we're kicking off the hour. And right now we are seeing mixed trading for the major U.S. stock averages. The Dow Jones Industrial Average is in the red, and it is off by 71 points. The Nasdaq Composite Index in positive territory and is higher by 0.17%. The S&P 500 trading flat this morning. So, Tai, let's check in with JD once again and hear about what's been going on during the conference. So, you've mentioned that you've attended for the second year in a row. What would you say is different this year compared to last year?
I mean, honestly, the scale, the size, and the enthusiasm. I mean, I think in terms of programming, one thing that is really clear is the interest in artificial intelligence, but it's not so much about the splashy pro-growth, pro-tech AI stocks. It's the ways in which artificial intelligence will change the client-advisor relationship for wealth management. And then, of course, Remy and Tai, since we are just a couple of months, really a handful of weeks away from the presidential election, a lot of conversations this year first time about protecting your portfolio in a potentially choppy political environment. But for the most part, every wealth management advisor I spoke with, every portfolio manager I spoke with says they are advising their clients in this particular political cycle to be patient, to allow to see how the dust settles and really get a sense over those first few weeks of next year's administration what those policy proposals will actually look like. Calm is the name of the game. That's one of the recurring themes that was really important in the programming at Future Proof with regards to the election the last week.
JD, to your point, as much as AI might be taking a bigger and bigger part of that relationship, what you've just said, that kind of advice from the advisor to the client, is something that AI probably can't do, or can't do with the surety that a person can. But are people worried about AI in terms of our advisors worried about clients potentially just dealing through an AI and sort of cutting them increasingly out of the equation?
Well, the recurring joke from a lot of wealth management advisors was, I may be biased when I say this, but hiring an advisor, that human component, is and will forever be, and should be, they argue, a crucial part to sound long-term investing. Most managers I spoke with here at Future Proof are really excited about what the prospect of artificial intelligence gathering further information historically on trades, better setting up their clients for success based on their own investment history, and being able to help clean up around the edges research components that might otherwise be some more kind of slower, more boring tasks for something like a family office. So honestly, a lot of enthusiasm for artificial intelligence. This was not the type of crowd who's talking necessarily about job displacement for AI. There's still a lot of excitement.
And JD, you've been surrounded by over 2,200 financial advisors, wealth management executives, as well as limited partners while you were there. So I do want to do a quick vibe check. So here at the New York Stock Exchange, we are counting down to 2 p.m. Eastern Time. The long anticipated, widely expected rate cut, we'll have to wait and see what happens in terms of the size of that rate cut. But what have the attendees at this Future Proof conference been saying as we head into the 2 p.m. hour today?
Well, I mean, it's a bit of irony, Remy, because so many of our friends from New York, top analysts that we speak to, reporters, a lot of them happen to be here for a few days on what's not just any Fed day. It's arguably the most consequential Fed day. Honestly, I would argue not too much programming was really geared necessarily to something as short-term as interest rate cuts for this Wednesday. To be honest, it was a bit more of a conversation we would kind of have after hours, our parties or events, because this is the kind of stuff we all kind of nerd out on, right? We really like talking about this stuff. So, ultimately, I think in terms of sound wealth management advice, it's not the sort of thing that I think is too immediate, as opposed to wealth management advisors really advising their clients on what the long-term trajectory looks like as interest rates come down. And of course, everyone wants to speculate: is it 25 basis points? Is it 50? Certainly a topic of conversation, but more of a fun one, I would argue, amongst friends versus established programming and investors.
JD, is there a general view of people leaning towards 25, leaning towards 50? Because as you made a great point, we haven't had a meeting like this where we're not sure for probably since 2007, if I recall correctly. So which way are people leaning?
I mean, it still, to me, it appears that people are leaning in the 25 basis point camp, or in other words, 0.25% off of the federal funds rate, although I was surprised to see the CME through FedWatch before we came out here seems to argue closer to 60% argument for a 50 basis point cut. But, some of our old pals, people like Dan Ives or Jay Woods that I know you have here on the show frequently, they have argued that if you go back to how the rate hiking cycle began, it started with smaller increments before going up to so-called jumbo interest rate hikes. And I think the idea is that the central bank would likely come in and do 25 basis points. And of course, if the Fed did come out and do 50 in the 2 o'clock hour yesterday, the market might do that as a bit of an admission that they should have started this process sooner. And I think certainly FOMC, Fed officials looking to maintain as consistent a posture as possible will largely underscore the decision we get today. So it appears as if it's 25, but I've certainly been surprised with the Fed before, to be fair, Tai.
And JD, as you mentioned, there is nothing like Wall Street and the New York Stock Exchange, and our friends are attending the conference as well. But I think it's also important to keep your finger on the pulse of the American consumer, especially outside of New York City, the East Coast. So recently, in terms of the latest economic data, we saw retail sales improve last month, but purse strings do still remain tight for a lot of Americans. And you've been on the ground in California at this conference asking what's the most important business story we should be talking more about. So tell us a little bit more about this and some of the responses you've been hearing.
Well, the responses have been all over the place. Believe it or not, there's still a lot of people in the financial world. They say we're still not talking enough about what artificial and certain components of artificial intelligence. An interesting answer I got from lots of attendees the last few days was the generational wealth transfer. What is happening with regards to an aging U.S. population, future impact on American healthcare, the U.S. economy, what it means for the policy proposals that are being put forward by both parties for the future of healthcare as one generation continues to age up and our workforces are shifting. So, really, I think in an overall sense that, there are certainly a lot of splashy things that we focused on in the markets, the Magnificent Seven and this stock, and rightfully so. But underneath the surface, a lot of concerns about structural issues and structural changes, not to mention geopolitics. Another one that I heard a lot about, just the true threat of future disruption to alliances and what that'll mean for things like commodities and markets around the world. A lot of fascinating insights for sure.
And Tai, you and I have been talking about this before the show as well, the fact that they're on a daily basis geopolitics as well as politics affecting the overall markets, especially when it comes to commodity prices.
Yes. As a matter of fact, I think the oil prices in particular have been sort of shrugging off. We have a lot of problems in the world. Ukraine, certainly the Middle East has heated up dramatically probably in the last 24 hours. And I think the first issue with Hezbollah's beepers happened while we were literally in the middle of the show yesterday. And I think the commodity markets aren't really pricing that in. I think we've seen a rally in crude oil, and I think it's good because there's some people, the market was very short, and I think they're covering some of those shorts. I don't know if you can go long thinking about something might happen, but I don't think I'd really want to be short at this stage, certainly not the energy markets.
And Tai, another thing that we have oftentimes talked about on this show is the generational wealth transfer, right? Because people are obviously living longer, and traditionally it might be 3 generations living in tandem, but if most people are living beyond retirement years and perhaps beyond the age of 100, that has a lot of implications in terms of stretching out your funds, doesn't it?
It does. One of the things that I think a lot of people rightly worry about is you don't want to outlive your money, right? So you want to, and the last section of the baby boomers, the last of whom were born, I think, in the early 1960s, are starting to retire. But that means there's a big portion of baby boomers who are in their 70s where they're now tapping into their money. So how it's going to be a really interesting question, and we won't notice it for years, how they manage their money. Are they going to spend it down quickly, or as you say, if they think they're going to live long, they're going to be a little more careful about it, invest in other things. So that has a lot of implications for fixed income. There are a lot of older people who are going to be in fixed income, but as interest rates come down, I mean, it's great to get 5% on your money, but if you're only going to get 3% of your money, do you feel that, for me to live in the manner to which I've become accustomed, do I need to go into, riskier investments?
Sure,
and it's actually a question I'd love to ask JD.
Yeah. Let's bring JD back in here.
Is JD, in terms of, I know in the past few years, alternative investments have gained a lot of interest, particularly things like private credit, where you're getting more money for additional risk. Was there a lot of focus on, at Future-Proof about sort of these alternative investments?
Yeah, you definitely hear about some of the other things that are worth cycling into, and you hear some really unique answers. I mean, it's outside of just things like, gold or particular things. I hear a lot about investing in things like precious metals, in particular commodities, and at the same time, what goes hand in hand with that, an increased focus on the geography of evolving nations and evolving economies. A lot of interest in India, a lot of interest in the Middle East, a lot of interest in Brazil. These are countries and regions around the world I hear such interest for, especially from people at a place like Future-Proof, because my sense is, Tai and Remy, that a lot of either wealth management creators or VCs, they are, experiencing those emerging economies and the opportunities there really for the first time. There's a lot of excitement, not just on advising their clients on a lot of these, alternative either things or places to invest in, but doing a lot of their own original in-house research, which is fascinating to read about what they think smart investments will look like. Not just for the short term, especially as we're dealing with interest rates finally coming down, but really that 10 to 20-year horizon.
And JD, I also want to ask you more about how artificial intelligence and technology is changing the advisor-client relationship, I imagine there must have been plenty of panels, plenty of conversations about this.
Yes, there absolutely were. And again, I stress the fact that, something for so many people here that love to talk about splashy stocks and what's moving the market one way or another. So much of this, especially in AI, these are kind of, more muted conversations, right? These are dealing with kind of the fundamentals and, some of those kind of wonky back end, procedural, at times bureaucratic things that a tech founder or a company and recognize how artificial helps streamline a lot of that data gathering. And then ultimately, I think there's a lot of confidence that AI can be used by the wealth management space to better predict what a client may be interested in based on their own investment history. Let's say for the upcoming earnings season or for the upcoming potential bull or bear market cycle. How do we use AI in a way that helps best set you up for success and even give us considerations for your portfolio that we might not have even thought about? So, and it's also interesting to hear how people are already using it. And of course, a lot of fun chat GPT style conversations as well that goes on in a place like this.
JD, did you get a sense from some of the advisors that you talked to that they're really investing in it, embracing the AI and see how AI can help them grow their business or maintain their business? Or is it more sometimes, I remember in the 90s when the electronic brokerage started to to come on strongly, that there was a reluctance of, well, we're just going to have we will have our relationships and this is really not a threat. Is there a sense of, are they really embracing it, or is it a little like you're going to have to drag us into it?
I mean, ironically, I think the only reluctance really on AI that I heard at an investment, a pure play long form investment festival like this, is reluctance to have the knee-jerk reactions that attach to AI stocks. Believe it or not, this is actually a festival where you're not going to hear a lot of, say, jump in on NVIDIA, oh, look how great these companies are doing. That's where the reluctance on AI comes into, because I think through the lens of sound fundamentals and patience, so many advisors are telling their clients not to have reactions. And so that, to me, is the only part where there's resistance on the AI story. But in terms of actually using it for their own offices, for their own firms, how it changes that relationship with their clients, I really only heard enthusiasm in terms of how they think it best sets them up for success in the future.
And when it comes to financial services, Tai, we know that there's a lot of regulation involved, right?
Yes.
So when you introduce a new technology, say AI, whether we're talking about advising clients or helping financial services professionals compile reports or do forecasting or build models, we know that regulation plays into this. So are there concerns when it comes to regulation and how financial services professionals are advising their clients?
I mean, it is absolutely a top priority for these financial services firms. I think to continue to kind of have these conversations, and what's fascinating is when you get together at a place like this, it's not so much the panels and the official programming, but you kind of see the light bulb moments happen in private one-on-one sessions. So one thing that's really interesting to your Remy, that Future Proof does that I really haven't seen at other events are these sort of speed dating style, what they call breakout or breakthrough sessions. And they're designed to just be basically 5 or 6 very punchy minutes one-on-one. And I had the opportunity to meet with a lot of people there and also observe other wealth managers connect and have those light bulb moments about how they're using a lot of these processes. And, ultimately, I think it's a type of industry, as any industry is, where there's a lot of competition, but also a recognition of emerging opportunities or emerging threats that can kind of raise all boats at the same time, rise all boats, and help them all lift together. So you really see that at a place like Future Proof front and center.
And JD, I'm sure that you spoke with a lot of professionals during this conference and of course some of these breakout sessions. So tell us a little bit about some of the conversations you had and what can you share with us?
Well, let me start with a couple of our friends. I'll start with the great Jay Woods of Freedom Capital Markets. Remy, even though he's a longtime friend of ours there on the floor of the New York Stock Exchange, it is very cool to be in a place like beautiful Southern California and get to interview your friends. And I want to ask Jay a few kind of unique questions. So because he is a technical analyst, he is a CMT, I want to ask him about any of his favorite stocks, his favorite names that are not necessarily household names. Jay Woods is driven by the charts. He's driven by the numbers, motionless investor. I do believe we have sound. This is Jay Woods of Freedom Capital Markets telling me his favorite stocks right now that are not household names. Take a look.
I mentioned transports earlier, Matson, MATX. It's not a household name, but it's a shipper. Like some of these shippers you see right out here in the ocean. Stock is one of the best performing stocks. That and Kirby, KEX, two shippers in the transportation index that just have, just sailed up and slowly, like a tanker themselves. And it's boring. It's not sexy. It's not going to make headlines, but it's something if you had in your portfolio, you'd be pretty happy about right now.
Remy and Tai, you can easily see.
We will actually.
Oh, go ahead, Remy. Apologies.
No, go ahead, JD.
I was going to say you can see the appeal to being out here to doing an event like that with a beautiful shot. And to Jay's point, MATX, that shipper up 16% year to date, KEX up 56% year to date. That's kind of what you get at a conference like this. It's conversations about things that are not super intuitive, not super top of mind, and that's largely what I want to get in my conversations with people on the wealth management side, as well as some old friends and technicians like Jay Woods.
And JD, you're absolutely right, because when we're speaking with Jay Woods here on the floor, we usually ask him about what's happening in the broader market in terms of equity indexes or Mag 7 names or even monetary or fiscal policy, as well as some of the charting. So it is good to hear his perspective, and I'm sure being out of the office, for us it's out of the New York Stock Exchange and being in Huntington Beach, that must be a really good backdrop for having these conversations.
It's definitely the type of place you want to have a lot of block and SPF on hand. I will say. Yes, also a lot of fun at the same time.
I'm hoping that some of those breakout sessions are on the beach or at least outside. I mean, it looks absolutely lovely there.
It's great, and a lot of credit to the founders. This event is co-founded by Ritholtz Wealth Management, and obviously it brings together a lot of the major power players across the industry. It's the third year that they've done it. And to highlight the point of fun, I really wasn't joking. There's a closing night concert that they do after you crush through all this new information for wealth management and advising your clients and asset management. Third Eye Blind with ex-ambassadors last night on the main stage here. So it's the final morning here at Future Proof, your final breakout sessions, your opportunities here to connect with people for my role as a member of the media, my chance to can together my last few interviews with people that I really want to speak with. And my goal, Remy and Tai, largely is to help bridge the gap between some of the very heady, very weighty, at times admittedly very complicated world of wealth management, and have the average person at home better understand how to access this world and what some of the complications, all these complicated things really mean for them. And that's been an awesome challenge the last few minutes.
In the impromptu conversations you've had, and sometimes you just pick up the best bits of information, what would you say are some of the significant concerns for the next year? Is there concern about valuation, that we've had such a steady advance, that are we going to advance more as interest rates come down, or do we plateau? Is there a sense of what are some of the concerns that you, sometimes they may not say it directly, but you've picked up sort of along the last 3 days?
I think it does actually tie in with our big central bank day later on today, which is the concern that maybe there are still cracks in the U.S. economy that we have not fully seen. Has the U.S. economy right now fully digested the impact of raising interest rates to a multi-decade high and keeping them there as high as the central bank did? There's always been a concern from many people on Wall Street to say, would we have to break the back of part of the economy to successfully bring prices down? It doesn't appear as if we've had, but we know the world that these lagging indicators operate in, and knowing that there could be unintended economic consequences many months down the line. That is a concern that I did hear from people. And then, of course, to the not necessarily the immediate politics of the U.S. election, but the global geopolitics, Tai and Remy, as we've already discussed, and how new alliances may jeopardize the standard or process of business that we are so used to. So those are definitely among the major concerns. It's just sort of the devil is always the thing you don't think about, right? What's that one detail we're not kind of considering? I heard a lot of that the last few days.
Right? It's sort of the unknown unknowns that you don't know what's going to pop up, and I guess having been in the market for a long time, it's the ones that you just don't see it coming that can sometimes be very, very dangerous.
That's exactly right. And
JD, while we And JD, I don't want to cut you off, so while you are with us for this half hour, I do want to ask you about some of the best investment tips that you've been hearing. I'm sure you've had the opportunity to speak with a lot of managers, financial advisors, and wealth management professionals. So what are they saying right now?
Absolutely. Apologies, by the way. Obviously, we're on a bit of a delay, so thank you for your patience. I think one of the biggest recurring themes I hear, Remy and Tai, it is time in the market. It is not timing the market. And I think that sound fundamental advice is really top of mind for a lot of people as we head into what could be potentially choppy, uncertain waters ahead in regards to finally lowering of interest rates, seeing how pricing is established, unemployment numbers, which have been ticking back up, of course, on the back of a wildly consequential U.S. presidential election, other elections in the next few years around the world as well. So, it's a lot of people who say, hey, you may not really like my answer. It sounds boring. It's not splashy, but you preach the fundamentals and you play the long game. And that is really, if I just sum up the vast majority of conversations I've had, that really is it. But I think that's actually really important for investors to know, especially in an era where day trading is as popular as it is, and people are largely gravitated towards the big splashy names that are very volatile, the Teslas and the Nvidias of the world.
JD, do you get a sense from some of these advisors, what do they think of these some of their clients are probably going to be active day traders or much more active in their portfolios? Do you get a sense of how they, I know it is time in the market. If you missed the best 30 days over the last 20 years, I think you've actually lost money in the S&P 500. But do you get a sense, any sense of what these advisors think of folks who like to trade in and out? Are they more difficult clients, or they have to be handled a little bit differently?
Honestly, it's not something that I think a lot of wealth managers want to talk about. I think my kind of sense is, hey, if I have clients that are interested in that part of the game, I'm going to maintain more of a hands-off approach. I mean, there are a lot of people in the asset management world who will use the word gambling. That's their own personal opinion, their own personal description of true day trading. And at the same time say, of course, it's no disrespect to people who have sought that type of access to the market, especially as access to trading platforms has been undoubtedly democratized the last several years on mobile apps and things like that. But ultimately, that is a different game fundamentally than largely what you hear at a conference like this. So, you certainly hear it. It comes up, especially from the technical analysts that are watching really key support or breakout levels, the way that Jay Woods or Dan Ives or Ryan Dietrich or JC Peretz might, right? Where you're really watching key levels of stocks. It's a different game altogether, though, if you're just kind of playing the short term.
And absolutely, JD. So before we let you go, I know you have a flight to catch soon. There are less than 50 days until November 5th, and you spent plenty of time in Washington, D.C., covering politics, covering elections. So tell us about the latest when it comes to polling, especially when it comes to the economy.
Well, we were talking about it.
And not just the economy, but especially among Americans who watched the recent debate between former President Donald Trump and Vice President Kamala Harris. I wouldn't say an overwhelming degree of favoriting Harris, but specifically on the question of who do you trust to handle the stewardship of the U.S. economy? Is it Kamala Harris or is it Donald Trump? Harris has the lead, and it's just about at or just outside the margin of error. And what is fascinating to me is that the latest polls from the Financial Times, from the University of Michigan Ross School of Business, from the University of Chicago School of Business, they're all showing that Vice President Harris seems to have the trust of the American people more on handling the economy than her own predecessor, the man who's the incumbent, President Joe Biden. So it appears right now, at least according to polls since that debate, Remy and Tai, that Vice President Harris has been successful in separating herself a bit, putting a bit of daylight between herself and President Biden on the economy. And again, it's without a doubt one of the most important issues. And Americans are saying, even right now, especially among those who watch the debate, Harris might be better off to help us bring prices down, even if she's a part of the administration that has seen the spike of inflation in the last few years. So, really important issue for voters. I think the polling, just a snapshot, not a predictive tool, but the snapshot tells us a really interesting.
JD, in terms of as a reporter in the media, do you get the sense that in terms of are people trusting the media to sort of play it straight, or is it sort of really the base or will the base sort of shrink into themselves, where Trump supporters will not trust anybody except Fox News or similar, and for the other side you only want to listen to MSNBC. Do you get a sense that people trust the media a little bit more, a little less, as we close in on election day?
I think the very definition of the media is evolving, and new platforms are popping up, and traditional ways of watching are breaking down, and people are launching new streaming shows. I think even the definition of what the media is continues to evolve. Unfortunately, I do think that I see more distrust in traditional media than I've noticed, over the last 10 years or so of my career. It's probably one of my personal concerns, this kind of tribalism or this sort of run to your corner, the echo chambers that can very quickly evolve throughout all corners of the internet. And people, therefore, being really surprised to learn contradictory bits of information or electoral outcomes because they were very clearly clued into the type of news they wanted to hear, as opposed to maybe some inconvenient truths about their own candidate or about the legitimacy of whatever it is. But I think that distrust is absolutely there. But hopefully all Americans, I always advise people, Tai and Remy, take in as many different bits of information as you can, listen to things that you don't agree with. It all makes you a more informed voter, without a doubt.
Okay, JD, well, thank you so much for joining us all the way from California. We look forward to seeing you back here at the New York Stock Exchange. So thank you for joining us for today's Market Insight, and safe travels back home.
Can't wait. Thanks, everyone.
Thank you, JD. And next up, Tai Wong and I will be taking a closer look at the markets with the market briefing. We'll be right back. Don't go away. Welcome back to Global Money Talk, live from the New York Stock Exchange and brought to you by Sampro TV. In the second half of the hour, I am joined by Tai Wong, independent proprietary trader. Tai, so we're back and we're going to be doing a market check right now. So we're seeing the major U.S. stock averages in a wait-and-see mode ahead of the rate announcement coming out today at 2 p.m. Eastern Time. Let's take a quick look at the charts with the Dow Jones Industrial Average. It is lower on the session, but fairly unchanged compared to yesterday. The Nasdaq Composite Index is lower as well, just down fractionally or 0.15%. The S&P 500 off by just 0.1%. So of course today is Fed Day, Tai. We've been talking about it for days now, and we finally get that rate announcement out at 2 p.m. Eastern Time. We're going to be listening to Powell with his press conference, as well as the economic projections. So between now and 2 p.m. Eastern Time, do you expect to see this pause when it comes to the major equity averages?
I think we're going to be in a holding pattern. I think people have sort of decided, I think people have decided whether it's going to be 25 or 50. They've probably decided what they want to do. They're tweaking their positions in terms of getting it just right. And you see that actually in the fixed income markets. Yields have backed up across the curve as people said, okay, even if they go 50, we're probably a little bit too much over our skis. So we've seen a little sort of correction there. You're seeing gold is a little bit lower, silver looks a little toppy, and palladium actually, which is at 7 straight rallies, is down 4%. It's called a bearish engulfing day, or an outside bear day. It looks like that is probably going to correct. It had a good run, and I used to trade palladium, so that's why I'm particularly interested in it. But I think all the markets are now sitting saying, okay, what is the Fed? If the Fed does 25, this is what I do. If the Fed does 50, this is what I do. And you better have your orders in, because the market is going to move in a handful of milliseconds once that number comes out. And it's been a long time since we haven't said that we felt we knew what the number was. So I think some uncertainty is good. I think the market should not always know what the Fed does. I know the Fed prefers, actually, in recent years, that they don't want to surprise the market, but a little surprise is actually sometimes healthy, and it gives respect to the central bank. And I think hopefully they learn this lesson. And we'll have more to talk about.
Yeah, absolutely. So whether we get that 25 or that 50 basis point cut, the thing is that the Federal Reserve is going to cut for the first time since 2020, so that's since the pandemic. And of course, this does set the stage for lower interest rates in the long term for the Federal Reserve. And I do very quickly want to take a look at some of the economic data that came out. So we got housing starts and building permits for the latest month here out in New York Morning Trade, and that did beat expectations. And you and I, we've been talking about falling mortgage rates and the implications of a rate cut for the housing market.
Mortgage rates fell for the 8th straight week, I think. I think it was 615. I thought it was what came out this morning. And housing starts were great, substantially above expectations. I think a fair amount of that was actually single family versus multifamily. And single family is really the important piece of the data, because single family says, or as we spoke about yesterday, you have to buy the appliances, you have to build the foundation in a house. That's cement, that's lumber, that's copper for the wiring. Multifamily has less of an impact, and I think multifamily is a segment that has been less strong, but single family homes, strength in there is actually really, really good for the economy. And building permits, I think, was up. So is this the market the home builders trying to front run the Fed, or saying, if the Fed's now going to be cutting rates, and it'll take us, I'm not a home builder, but it might take me 9 months, a year, or maybe more to get a house from start to finish. Well, let's get started now, because as rates come down, we're going to get a lot more demand, and maybe it's this pent-up demand that we from the last couple of years when rates were so high that nobody who had a mortgage was willing to sell the house and lose that really nice mortgage.
And of course, we'll have to keep an eye on what happens in terms of mortgage rates, but of course that will have an implication on home buying across the country. And before I move away from what we're seeing in terms of the housing market, one area that I want to ask you about is commercial real estate, especially since we're in New York City and we're starting to hear from the major corporations about the return to the office. And we know the last couple of years, especially in a metropolitan area such as New York City, working from home, being allowed to come into the office just a few days a week, we know that this has severe implications in terms of business cycles in big cities across the country. So what do you think will happen as we head into 2025 when it comes to commercial real estate?
I think commercial real estate looks like it's going to continue to struggle. And the reason is, if you look at people who, and I know someone who's in the building services area, which is the people who actually supply the cleaning fluid and supply the paper towels and the toilet paper, which you always need, and other things like that. And they're saying that their level of what they're selling is only probably 60, maybe 65% of what it was pre-pandemic. So even though you get headlines like Amazon bringing everybody back, there's flexibility in it, and I think it'll be a long time before we get back up to where we were before. And at the margin, that's where people, if it's commercial real estate, when there's demand up to 80%, 85%. That's when you can start charging rents and make a lot of money. At 65%, even though my parking lot is full Tuesdays through Thursdays, that might just be the demographic of the town that I live in. More people are coming in, but I think they're struggling. They will continue to struggle, and I think we need a little more pain. I think we probably need some failures, some defaults, and then when sentiment is at the very, very bottom, like it was in Intel, different sector, last week is the time to really get into it. But I don't think we're there yet. I think there's a little bit more pain to come in commercial real estate.
And Tai, you and I always talk about this in terms of the subways as well as transportation here in New York City, and we know that the landscape has changed so much. Personally, outside of the New York Stock Exchange, it used to look so different before the pandemic, and we noticed a lot of the businesses here, they're still quiet despite more people returning to the city for work during the work week.
Yeah, and not having people in the office really impacts the merchants around the people who sell breakfast, who sell lunch, the poor guy who has the cart.
Yes.
Right?
Coffee,
he
bagels.
Exactly. The people who the cleaners who do the shirts. I know cleaners have gone out of business. I see them every week, and I'm like, how's it going? He goes, not what it was. And you can see, this is part of the not just the pandemic, but how we changed maybe in part due to the pandemic, but you feel bad for the boot blacks who used to have a lot of shoes to shine. And most people now, you can see on the floor here, people are wearing soft shoes or wearing sneakers because, frankly, they feel better. They're better for my aging knees. So there's been a big impact. I think that continues to be felt.
Yes, absolutely, because when you walk around New York City, in particular areas where formal attire is expected, you still see more casual wear, athleisure, entering the workplace. So I do absolutely agree with you when it comes to dry cleaners and some businesses we used to rely on pre-pandemic. They're no longer around anymore. Right. I'm down to one cleaner in town. I've got to use that cleaner now. There used to be two. Well, it might be better for overall health. Yeah, that is true. That's true. And I remember I used to walk to work, and I would pass by Brooks Brothers, the big flagship store on 44th and Madison, and it's gone. That ship sailed, and now it's a coffee shop. Which is says a lot about how the market has changed. But the pandemic and work from home has had a big impact. Absolutely. So, Tai, as we head into the final minutes of the show, I do want to very quickly do another market check and take a look at just the S&P 500. So this is an index here where we've continued to see new highs, but in today's session it is lower. It is off by about 0.15% on the session. So do you expect to continue to see higher levels as we head into the rest of this year? So that's a magic question, and it is what is the Fed going to do? What the dot plot, does the economic projections look like, and where what Powell says at his press conference. So it's really a three-prong attack this afternoon. So I think what we'll see is the S&P 500 I think hit historic highs maybe by a point yesterday and finished lower. So it's historic highs. It's great. I think actually the market will now, even though I think the majority of
economists are saying 25. I think the market, the speculators, the people who really move the markets are really thinking 50. So the whisper number really is 50. So if we get 25, I think we're going to get a much more violent market move than if we get 50. If we get 50, I think bonds rally a bit. I don't think it rally a huge amount because we're already there, and it depends again on the dot plot. Where does the Fed, these Fed governors see us at the end of 2024? If they go 50 and they only see us, at 75 basis points or 100 basis points of cuts instead of 150, which is what some of the market wants, that's going to impact how the markets behave. So hard to prognosticate, but I definitely think that we will get a more negative reaction in most markets, other than the dollar, if it's actually only 25 and not 50, after we've been sort of teased into 50. And been doing some thinking about it, and why did this Wall Street Journal article come out, right? Did Jay Powell at the end of the week say, you know what, it's 90-10 for 25, and there's a chance we might do 50, so I need to put it into the mix. So I'm gonna call Nick Tamarias and say, can you put that into the mix? And if that is indeed what happened, and I think a lot of people believe that's what happened, they've done a great job. So does that mean Powell wants 50? It's unclear. And if you look at the Federal Open Market Committee as it stands right now, a lot of these governors are pretty new. And some of the regional Fed presidents who are voting are also pretty new. So there is more uncertainty in that. I happen to know that Atlanta Bostic is that tends to be dovish, and John Williams of New York tends to be a little hawkish. But some of the other ones, we just haven't seen enough of how they vote and how they speak. So it really is a little bit of a cipher. And then finally, are they going to be 50 and have a sort of very neutral press conference? It's 50 and we're going to see. The market's not going to love that. I think the market might dive on 25, but if it says 25, we're going to continue and we will absolutely go bigger if we need to. You're going to get a big dip when it comes out, and then at 2:30 or 2:45 when he starts this, when he really gets into the press conference, you might get a big rally. So it's going to be a pretty volatile afternoon.
Yeah, and I'm sure you and we will be in front of our screens, whether we're looking at our laptops, our smartphones, or iPads, our devices. We're going to be listening very closely to what Jay Powell has to say.
And, it's one of those, being sort of wonky about this, is you look at the minute-by-minute chart, and I look at it in gold because I'm a gold trader, and you can see the comments that he makes, it will immediately hit the price. And because the press conference, I think, is sort of 5 or 7 seconds delayed, you actually see the price action before he says it, which is really remarkable in terms of, you don't want to be watching a tape delay if you're actually trading. If I'm just, watching and, thinking about what the overall picture is going to be, okay, but 7 seconds is a lifetime.
Yeah, you do bring up a great point there, because you might see the price action move on a chart, whether you're talking about you're watching the equity indexes, whether you're watching gold or you're watching the FX market. And nowadays, with our access to technology, you might have a terminal up, we might be hearing a few second delay of that press conference, but access is key here, isn't it?
Yes, absolutely.
Yeah, and for our viewers out there, I think it might be very helpful to walk through the dot plot. I know there are expectations for the dot plot, and of course whether we might see a hawkish or dovish commentary or expectation heading into November as well as December. But here on Wall Street, it's very interesting because there are a lot of animal references, right? Bull versus bear, hawk versus stub. So can you walk us through this?
So the dot plot itself, really what's going to matter is the 2024 dot is where they see it at the end of 2024. It's sort of like a scatter plot. Is it 100 basis points below where it was? Is it 75 or is it 125? The market right now, the futures are predicting somewhere between 100 and 125. That's going to instantly veer towards 150 if they go 50 basis points, because then they go, maybe we'll do 50, 50, 50. The end 2025 dot is going to move maybe maybe 25 to 50 basis points, because they already have it substantially below where the end 2024 will be. And then what you don't see is in 2026 and the long-term neutral rate, you really don't see that move very often. A move actually in the long-term neutral rate, if it is unlikely, but if and when you see that, it's actually pretty important, because that says that will signal to the markets, and it's going to hit the longer end of the bond market quite substantially, is where do they think long-term rates have to be? Is it 2.5? If that goes to 2.75, or if it shifts, that will the bond market strategist will be all over that the next day, because that's really important. And many of us think, myself included, that I think where the long-term neutral rate, I don't know if we're going to get inflation at 2% on a going forward basis for a number of reasons. So if that's going to be higher, the long-term neutral rate has to be higher. And that has a lot of implications for books with long duration, where they have long, which is basically sensitivity, portfolios that have sensitivity to long-term interest rates.
And I also want to ask you about the effect on FX markets, in particular after this rate announcement comes out. So what do you think, just based on your expectations, what can we see in the FX markets?
Well, let's take a look at where dollar yen is right now. I think I realize I haven't looked at it for half an hour. Dollar yen is actually trading at 142, and it got up to a high of 142.43. Just the other day, it was below 140 for the first time in 14 months. So I think the biggest impact you'll see immediately is dollar yen. I think the market was short. The speculators were short dollar yen, and they've been covering the last few days. So I think dollar yen, the dollar rallies substantially if it's 25 basis points. I think we could see 140, certainly 143, maybe even 144 over the next couple of sessions, until really everything sort of settles in and the market digests what the Fed has said. And let's see if the Fed sometimes, starting tomorrow, the blackout period is off, and if the markets reacted not the way they want to react, somebody will come out and walk it back a little bit. Somebody like John Williams, head of the New York Fed, they'll say something, and if something is not, is sort of, Powell says something and the markets really over focus on it. I remember his first press conference, and he said a few things that the market went, and he's gotten much better at that. And you have to remember, the man has training as an attorney, so I mean, I think he's one of the really great presidents, because he can speak in terms, even though he's an attorney, like normal people understand him.
Yes, I think that's just so
awesome,
important, like simplifying that.
That's right, that's right.
And I'm glad you brought up dollar yen, because right now in New York morning trade, we are seeing that currency pair straddle 142. And if we zoom back to earlier this summer, in particular the end of July, beginning of August, we were hearing about the unwinding of the carry trade. And when it comes to global central banks and rate differentials, this is really important.
Yes, and whether the people, if they go 25 and it looks like a steady 25, that carry trade from here might come back a little bit, because the Japanese don't look like they want to move rates very quickly, and they won't move it a lot. They're not going to raise it a lot. So the rate differential is still going to be substantial, but in FX, definitely not yet.
And one other point I do want to mention is, while we're talking about commodities, FX market, in today's session, oil. So we talked about inventories yesterday, but of course the big question is, you and I have been talking about what happened in Lebanon yesterday, the Hezbollah being attacked in terms of their beepers, and today in terms of the walkie-talkies. So can you tell us a little bit about what you make of the latest headlines we've been getting out from the Middle East?
So I'm just taking a quick look at oil, since I haven't looked at it since the beginning of the show.
So we have the chart up right here
excellent.
as well. So let's take a look at that.
Excellent. I think crude has come back quite substantially over the last week or so. I think the market is now correcting some of that bounce. The data that we had just at 10:30 this morning, I was also looking at that because I had just come on. It showed that crude stocks were down 1.6 million barrels versus up 830 some odd barrels expected. The consensus was flat, so this is sort of bullish news for the crude market. And crude stocks are actually overall, I think global stocks are at 4.4 million barrels, and that's really on the low side. The market is not really worried about that, but maybe they should. And as you mentioned, and I think the news came out when we were looking at during the show yesterday, that Hezbollah had its, all its beepers, 3,000 beepers, exploded, and what is likely to have been an Israeli attack, and a shockingly effective attack as we can see. And then this morning again, looks like their walkie-talkie radios have also exploded, and they've just gotten a new shipment of these radios. So my concern here, and it hasn't been reflected in the energy markets, is Hezbollah will retaliate. They have to. You can't take a hit like this and not retaliate. The question is, what kind of retaliation will it be? Will it be, all right, we'll shoot a few hundred missiles, have a lot of rhetoric, and let it go? Or is it going to be some massive retaliation that widens that conflict and potentially draws Iran in? And I think if we get the latter, I don't know what it's going to be. I mean, this is somebody called it a decapitation strike. They hit pretty much all the senior Hezbollah members because they all communicated via beeper, and perhaps these walkie-talkies as well. Are they saying, what, we'll answer, but we won't widen the conflict? I don't know. But if that conflict widens, I'd be worried about oil shooting up very, very quickly. Now, that said, it's sometimes really tough to trade oil. I think something really bad is going to happen, so I'm going to be long. And oil is actually a really hard thing to trade because it's futures, and it's monthly futures. So you have to roll those futures, and futures rolling, maybe we'll get into that on an Insights one day, can be very, very expensive. So I think I would definitely not be short oil. And, if I was a speculator, I wouldn't be short oil. Maybe it's not enough to be long, but this bears watching, and I'm really shocked to see that there was a second strike on Hezbollah this morning.
And you and I, Tai, before we started the show at the top of the 11 o'clock hour, we were reading through the headlines that were coming through. This does raise a lot of geopolitical concerns. It raises questions about security, intelligence, as well as supply chain, doesn't it? It does.
And supply chain was something that at the beginning, during, and right after the pandemic was a big deal, and now people have forgotten about it. But shipping rates have really come up sharply over the past few months, and it's not on somebody's radar screen. It's sort of like something that you never think about until there's a problem. And if you get higher shipping rates, suggests that they have pricing power, but also that we may have some issues with supply chain again. And Americans have forgotten what it's to be like that. Oh my goodness, we might run out of toilet paper, so let's go to Costco and buy crate loads of this. It's a serious issue, and I think we may see more of it as time goes on.
Yes, I do agree with you, and it is no laughing matter. I was just thinking back to March of 2020 when toilet paper was in short supply, and hopefully we don't have to face that yet again. But I also do remember how a lot of the manufacturers, they had an oversupply of commercial toilet paper for offices because everybody had been going home and no longer commuting to offices. So it really does make us reflect on what happened 4 years ago, and I think it's so timely, Tai, since we're here ahead of the Fed rate announcement, and we're most likely going to see a cut from the central bank later today.
Absolutely.
Well, we will be back here bright and early tomorrow morning, and we will be bringing all of you the latest regarding the Federal Reserve and the implications going forward for investors and the market. That will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. And you can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us, and we'll see you bright and early tomorrow. Have a wonderful day.